insurance is a disaster.
I'm placing new order to sell short euro at 108,395. Sorry, new order placed to sell short euro at 118,395. Okay, let's see if it will get executed. Okay, position open, short on euro, 118,395.
Capital principal and co-founder Kathleen, we talked earlier this year when all of the IPO markets ground to a halt in the face of the escalating pandemic. Now we have the opposite, with Airbnb lining up and saying that they're going to come to market. Is there an end to this appetite, or do you see it continuing to pave the path to more volume ahead?
Well, and even the global pandemic couldn't hold it down. So as you said, after a very slow March, we came from off of July. We're now even with last year. July has been the busiest month of July since 2014, and this will be the busiest month since 2013. So we're on pace to have the highest levels in over 5 years, and may hit a record if some of these big unicorns like Airbnb, Palantir, DoorDash go public. And we are seeing a rush of deals to get done. A couple of reasons. One is ahead of the election, where the market can get jittery, and that can slow down and has historically slowed down issuance. And then we're seeing a very interesting rush of Chinese companies trying to go public here before some changes are being implemented about disclosures.
Talk a little bit more about that. You're seeing a rush of Chinese companies trying to get in before the U.S. cracks down on their auditing practices. Is that right?
That's right. The rule is going into effect. So by the end of next year, all Chinese ADRs here are going to have to comply with the U.S. auditing oversight, which every other company has to do. I find this is a carve-out that probably we never should have had, but we had given to these Chinese ADRs. Last night, for example, KE Holdings, which is one of the largest residential real estate transaction companies, 10-cent-backed platform, raised over $2 billion, one of the largest Chinese ADR offerings in over 2 years. And that priced above the range that's going to start trading today. And we've also seen other companies line up, XPeng, a Chinese electric car company, Lufax, a peer-to-peer lender, going to do very large IPOs and try to get through this window before new listings will have to comply. And I think there may be an actual restriction on any new listings that don't come out with this extra oversight required now for all companies.
There's a broader, Kathleen, there's a broader question here. As companies race to get into equity markets right now, they sense that the iron is hot, they want to strike. Are they getting valuations that are too high given where the economy is? In other words, has Fed largesse pushed enough investors into riskier assets that perhaps things are getting a little frothy even at a time of economic distress?
Well, it surely helps to have the Fed at your back with low interest rates. And low interest rates really help growth companies. And growth companies are the bread and butter of the IPO market. We've had some interesting things happen with the IPO market. There are about half of the dollars raised are now being raised in blind pools called SPACs. The rest are regular way IPOs. Our Renaissance IPO ETF tracks an index that has significantly outperformed the overall market. And that's because the regular way IPOs are being priced more reasonably, if you could say that. It's always relative to the peers, and the market is frothy in general. But it's the SPACs that are out there with an ability to raise capital in a blind pool and then purchase what we think are the very risky companies that can't get through the regular way IPO market. And so that's becoming an outlet for some large companies that do not earn money that would be very hard to value in the regular IPO market. So we're seeing that element. It's reminiscent. Those kinds of companies are reminiscent of the internet bubble of '99. However, our data shows that investors should be cautious about looking at SPACs. The average performance after a merger, for SPACs underperforms the regular way IPO market. So we have this very interesting, I'll call it internet bubble, a .com, reminiscent .com happening with SPACs.
And for people who don't know, it's a special purpose acquisition company. Bill Ackman getting in on the action, as well as a number of big firms. Basically, they raise a pool of money, set it aside, invest in treasuries, and then when they find an acquisition that they want, they get some of the shareholders, the people who bought the shares, to vote on it or otherwise redeem their money, and then they take a company public, but at a fixed price. So in other words, Kathleen, given the fact that we've got $1 in $5, I believe, currently being raised for SPACs in the IPO market this year, a record, do you think that these are set to underperform? Are you actually staying away from them?
Well, for us as an investment manager and managing ETFs, our ETFs own operating companies over the largest ones that have come out into the market over the last 2 years. So we're focused on that. The SPACs don't actually become an operating company for almost 2 years. So we do not include them. We do think, we would, so our existing products don't. Our conclusions right now with SPACs are it's not one of these buy and hold places to be. The average performance, and in fact, we're getting 2 out of 5, or if not more, dollars raised in the IPO market are SPAC dollars now. But our data shows that there's negative performance of the ones that have on average, made acquisitions. There's negative performance for all of them compared to positive performance for regular IPOs. The thing is that investors get very excited with the moonshots like DraftKings, which is up 200%, Virgin Galactica, Nikola. They've been the exceptions, but not the rule. So it'll be interesting to follow them, especially as they go through their acquisitions.
Kathleen Smith, thank you so much for being with us. Kathleen Smith of Renaissance Capital. Right now in the markets, we are seeing a lift following the better than expected jobless data. Still a pretty dire headline number based on history, yet below 1 million individuals for the first time in, I believe, 22 weeks. Right now, we're looking at the NASDAQ leading the charge here. S&P also up barely. A churn here, but still a churn now to the positive. You're seeing 10-year yields tick up. They had been lower earlier. This is ahead of that 30-year auction coming at 1 p.m. Eastern. We are going to get, I believe, $24 billion of 30-year debt sold. The euro getting stronger versus the dollar. VIX coming down. Coming up later this morning on Bloomberg Markets, we're going to be getting word about JetBlue's focus going forward. What is the future of travel in an era of coronavirus and people's concern about getting sick when they go on planes? We're going to be speaking with Robin Hayes coming up. From New York, this is Bloomberg Surveillance on Bloomberg Radio and on Bloomberg Television. Tom Keene will be back next week following his move. This is Bloomberg.
True diversification. That's what adding commodities exposure to your stock and bond portfolio can help provide. The Bloomberg Commodity Index is the standard for commodity market exposure. 23 traded commodities are represented: agriculture, livestock, metals, and energy. The Bloomberg Commodity Index is the benchmark most widely used by investment professionals globally. Track your commodity investments with a proven financial information partner. The Bloomberg Commodity Index. True diversification.
I'm David Weston. Bloomberg Television is reinventing one of the most iconic brands in financial television for a new audience. Join me to see the news program for the clever investor. This is Bloomberg Wall Street Week.
The rapidity with which we are moving relates more to technological advances in how you can make a vaccine even before you start testing it. That makes me confident that we are going to do everything we can to determine safety.
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
From New York City for our viewers worldwide, good morning, good morning. The countdown to the open starts right now with 30 minutes until the opening bell. Equity futures just turning positive. We begin with the big issue. Within a whisker of all-time highs, a 50% rally off the March low, taking us back towards a record. A rally fueled by unprecedented stimulus driven by uber-cap tech stocks seemingly minting money when most of us were still locked at home. It's a market that has tracked the economy a little more closely than some would suggest. Tech stocks aren't up 24% this year because the economy was looking good. The KBW Banks Index is down 30% precisely because it wasn't. With the economy slowly recovering from an ugly contraction and markets at lofty highs, Washington just isn't feeling the heat in quite the same way, even if it should be. We face an impasse in the nation's capital, with politicians continuing to do what politicians do best. Democrats blaming Republicans.
In terms of the negotiations or lack thereof, I was just writing to my colleagues about how children are affected by these negotiations. When commentators say to me, why can't you resolve your differences? Because we're miles apart.
And Republicans blaming Democrats.
The bill's not going to happen because they don't even want to talk about it, because we can't give them the kind of ridiculous things that they want that have nothing to do with the China virus.
So what breaks first? Talks on the road to nowhere on Capitol Hill, or a market on course to surpass all-time highs? Kevin Cerulli joins us now down in Washington, D.C. Kevin, the blame game continues this morning.
The blame game continues this morning, and the economic data that we just received with regards to weekly jobless claims falling from below 1 million for the first time since the pandemic would only rather embolden both Republicans and Democrats in their respective camps. That positive economic data could potentially mean that they really have even less of an incentive in order to continue to negotiate. I'm told, however, by sources up on Capitol Hill that the talks are back-channeled at this point. They're trying to agree on some type of top-line number. We've talked about this over the last few days, John, about really how much money they are willing to spend, because Republicans don't want to concede the issue of ending up with something like $2 trillion. Meanwhile, Speaker Pelosi and Democrats don't want to say that they are able to go significantly less than they had originally allocated for. I'm struck by the notion of the unemployment benefits, because that is definitely going to be not just a policy debate, but also a political one. I mentioned this yesterday, but I'm told that it bears repeating. Senator Kamala Harris, of course, now the vice presidential pick for Joe Biden's presidential campaign, she has really been at the forefront of the debate for trying to argue for $2,000 worth of funding for families that earn less than $140,000. Why that matters is because it's going to really tap into this populist debate of a political summer that has been completely turbulent, to say the least.
Kevin, do we have any talks scheduled in Washington again today, this Thursday?
There's no official talks that are scheduled, but I can tell you that based upon my reporting, there are phone calls and staff level talks that are continuing to happen around the clock. So when you look at the communication that came out yesterday between Speaker Pelosi and Secretary Mnuchin, it really was the most tense that those two had engaged with for quite some time. As a reporter, having covered this, especially in previous negotiations, Speaker Pelosi and Secretary Mnuchin really had been the two individuals who had the positive relationship that really I don't want to say that they had open lines of communication. If you look at the comments from yesterday, that would suggest that relationship has turned fraught during these negotiations.
Kevin, what do you think breaks the impasse down in Washington? Because right now I've got a market within a couple of tenths of 1% of a record high. The economic data is not great, let's be clear about that up front, but it continues to improve. Where's the heat coming from?
Well, I was speaking with a wonkier financial services source yesterday, and ultimately, if Republicans can convince some Democrats to get on board with some tax incentives and maybe some even, wonkier tax incentives, not something like capital gains or payroll, for example, but some more business incentives, and if they could bring on board some centrist Democrats, you could see some Leader McConnell and other and Mark Meadows orchestrate this behind the scenes as well to say, okay, we're willing to spend a little more money for state and local governments, provided that there are transparency requirements.
Kevin, great to catch up, as always. Kevin Cerruti there, down in Washington, D.C., our chief Washington correspondent. Run about 25 minutes away from the opening bell. Equity futures just about turning lower. Negative on the session by not even a tenth of 1%, down a single point. Coming into Thursday, within two...
I'm placing stop on profit for euro at 118.375. Okay, 118.375. Stop on profit placed.
Most levered to the recovery. The wonderful Morgan Stanley's Mike Wilson joins us now. Mike, let's start right here with the fiscal talks first up. What do you assume will happen in Washington that underpins your current research?
Yeah, thanks, John. I mean, this is the debate of the moment for sure. I mean, this is critical to the recovery. If we don't get it, you can, kind of put the recovery away, and we'll probably have a double dip of some kind. So it is our presumption that we will have success in this negotiation ultimately, and this is the way it typically happens, right? You get this 11th hour, bargaining, so one side can take more credit than the other. And really what it does, as you push this out, it probably means you're going to get a bigger package ultimately. And that's kind of where we're leaning now is ultimately, first of all, we think the package will get passed. It'll probably take a little bit longer than what people were anticipating. That puts more pressure on them to do more, maybe get a little bit of market pressure to do that. And you could see a package as big as $2 trillion at this point. I mean, is my guess. We don't really know, but it's going to get passed as our view, and this is going to be critical to extending the recovery that we've been looking for.
And I assume it would be critical to the rotation call as well. Mike, just compare and contrast the rotation that faded, stalled in early June, to the small one that developed Friday into Wednesday.
Yeah, so I mean, look, I think the market has been undergoing a bit of a correction under the surface since June 8th. That was the big payroll numbers, you recall. 10-year Treasury yields went up almost to 1% at that point, and that was kind of the peak of euphoria around the reopening trade, if you will. That's when small caps are really leading, and the cyclical stocks it's kind of been our view. We've had a view that if you really want to have a barbell strategy, you want to own COVID beneficiaries as well as some of the stocks that have actually suffered from the pandemic and lockdown the most, because that's where the operating leverage is going to be the greatest. And we think the opportunity is in that latter set of stocks now, because that has been going through a correction. I think the difference between sort of what's going on now versus back then is that we're closer to the moment of truth on this particular fiscal package. This fiscal package, I think, is going to be a catalyst for rates moving higher, which is the key to all of these trades in our view, meaning there's been a long duration trade everywhere in every asset category as rates have moved down towards 50 basis points, which we think is kind of a rock bottom low, unless the Fed wants to go to negative rates, which is not our view. So the fiscal package, ironically, could actually stimulate the perception that maybe the economy will be better next year. Rates shoot up, and that will affect that rotation back towards these COVID beneficiaries in the recovery stage, the cyclical type stocks that we've been recommending.
So, Mike, this is really important. You're overweight financials, you're underweight tech, but as you acknowledge, at the epicenter of that is a rates call. And I caught up with your colleague Matt Hornback at Morgan Stanley recently, looking for those high yields. Mike, what is it that pushes Treasury yields higher in a low-rate world for a whole lot longer?
Well, remember, we're not talking about front-end rates, right? So, John, I mean, the Fed has front-end rates locked down, and we firmly think they're going to stay there for the foreseeable future, not indefinitely, to fund these deficits. But the back-end rate is a function of a lot of different things, right? The back-end market is a function of not only what the Fed's been guiding to, but also inflation expectations, which have been rocketing higher, also nominal GDP growth, which we think will end up being much better next year than what perhaps the consensus is thinking. And as we get closer to that nexus where the market has to go in that direction, you can get a big move in back-end rates. And the Fed has not said specifically they want to pin rates at the back end. In fact, it would help their cause to get more inflation in the system, because if you create some steepness in the yield curve, you know, it sort of encourages lending, which is how money supply is created, and you get inflation. So I think it all fits together. The key factor, though, the only way rates can go up in a healthy environment is if the economy continues to improve, right? If back-end rates start going up for bad reasons, you know, for example, you know, credit risks in U.S. Treasuries like back in 2011, that would be terrible. But if rates start going up because the economy is better and because inflation expectations are moving up, that should all be conducive to what the Fed's trying to achieve. And so I think it all lines up nicely.
Mike, there's some confusion on what the Fed is trying to achieve and what they might do next, specifically at the long end. If they came out and talked up yield curve control and looking to cap long end yields, would that drive a wedge in between your call and what can actually happen?
I think that's right, John. So let's talk about that scenario. I mean, they have not really gone there yet. At least I haven't heard those words. Some people may disagree with that, but I don't think they specifically said they want to target, you know, pin rates like they did back in the 40s at the back end. Because I think if they were to do that, this is me just talking out loud, thinking out loud, which is if they were to say those words, I think it would be pretty damaging to the U.S. currency. And obviously the U.S. dollar has already weakened substantially, and that is somewhat inflationary. So, you know, to go there, I think it would be akin to the Fed giving up control of its balance sheet in many ways, saying we have unlimited firepower to pin rates. Nobody would doubt them, but what does that do to the currency? Right, so I think you can only do one or the other, and right now I think the Fed's doing a good job of threading the needle on, you know, forward guidance, which is keeping expectations low for not only short-term rates but long-term rates, but understanding that if things get improved and the virus, you know, gets better next year, that back-end rates should go up. That would be actually helpful for the recovery story, quite frankly.
Mike, I wanted to finish on something important that you've mentioned in your research in the last several weeks, over the last month, and that's on financials and how they perform at a down market and an up market. We've seen evidence that they can outperform at a down market. You've talked about this. Can they outperform in an up market?
Well, we'll see. I think it does require rates to move higher. So, you know, our recommendation to be overweight financials is contingent on our view that back-end rates can move higher, okay, as the recovery improves, and that won't derail it. I think there's a debate in the marketplace now that, you know, 10-year yields have to stay below 1% or else the recovery will falter. And look, I just disagree with that. I think the economy, given the strength that we see, assuming the fiscal package gets passed, of course, we see enough strength next year that the economy could easily handle 10-year rates above 10%, and that shouldn't be a constraint on you know, what the Fed's trying to achieve. And once again, if rates are going up at the back end because things are getting better, hallelujah. I mean, that's what we're trying to achieve.
Mike Wilson, always a privilege, a pleasure. Great to catch up with you. Send my thoughts to the team at Morgan Stanley. Coming up on this program, Fed officials warning failure to control the pandemic is undermining the recovery. We'll bring you some sound of that next. Charles Schwab's Colin Martin joining us to discuss. From New York, this is Bloomberg.
This is Bloomberg Best, your weekly review of the most important business news, analysis, and interviews from Bloomberg Television around the world.
Ken Burns, welcome to Bloomberg Big Decisions.
We have always been a mixture of things. We are always stronger for that mixture.
Growth is a way to stay competitive, delight more and more consumers.
Welcome to the Best of Bloomberg Technology. I'm Emily Chang.
They've moved the needle by acknowledging that they have to monitor the content.
What is one word of advice you'll take with you?
Learn how to listen. And that is certainly something that has served me well.
Ankiti, where do you go from here?
It's a huge market. It's a huge opportunity. I want to go 100x from here.
Our philosophy is to partner where we can and stand apart when we should.
Europe does, as you say, have some catching up to do on that front. So we are expecting to see a little bit of strength coming through at the start of trade. How long will it last, though? The perennial question.
The Boston Symphony Orchestra presents BSO at Home, a collection of concerts, at-home lessons, and behind-the-scenes stories to enjoy while you stay at home. Learn more at bso.org/at-home.
My personal assumption in my forecast is that some form of additional stimulus is going to occur. It would definitely be bad news both for my forecast and for the economy if we don't do any additional stimulus at this time.
Boston Fed President Eric Rosengren also among those flagging over-eagerness to reopen the economy, saying the following: limited or inconsistent efforts by states to control the virus based on public health guidance are not only placing citizens at a necessary risk of severe illness and possible death, but are also likely to prolong the economic downturn. Mike McKee with us now. Mike, fantastic interview, sir. Your thoughts on what you heard in the last 24 hours?
Well, you know, John, there is almost no debate about the fact the United States did a terrible job of controlling the coronavirus, but there has been a debate about whether or not it is more important to control the virus or reopen the economy. And the Fed officials who have been speaking lately, including Eric Rosengren yesterday to me, have taken the position that it is more important to control the virus, because as the virus comes back, businesses shut down in those states. And you can take a look at a chart here that shows what Rosengren is talking about. He's looking at the high-frequency indicators, and you can see in the hard-hit states there how retail sales have fallen off and or just sort of plateaued. The economy starts to slow down again, and despite today's jobless claims numbers, things don't look good if we continue to have the virus. And they're saying we should focus our efforts on trying to get that done. And then, of course, the Boston Fed president saying we also need fiscal stimulus. The Fed's done about all it can do at this point, and they need to do something down in Washington to keep the economy reopening. There's another chart that is one that is becoming quietly a favorite on Wall Street, and that's the New York Fed's weekly economic index. It sort of combines a lot of these high-frequency indicators into something that suggests where we are in terms of GDP. And you can see over on the right-hand side in the circle there how it has turned down in the last week or so. It may be revised up today because of the jobless claims numbers, but we're still almost 7% below where GDP would be at zero. So we're still in negative territory according to this weekly indicator from the New York Fed. And as I said, Eric Rosengren was telling us there isn't much more the Fed can do. I asked him about changing forward guidance, and he said, we probably aren't ready for that because we're at zero and all rates are at pretty much zero or just above it right now. Asked him about yield curve control, and they're not interested in that at all right now because they don't feel they need to, with rates being where they are. The action, he says, is in Washington in trying to control the virus and getting fiscal help out.
Mike, your thoughts on how comfortable they would be acting closer to the election? It's something you've touched on. Just expand on that for us.
Well, there's a myth that the Fed doesn't act in election years. They do, but there isn't much for them to do at this point, and their general feeling seems to be if we could stay out of the way, it would be better. They're taking a political position in a way by saying we need to control the virus and we need some sort of help from Washington, but they're not endorsing any particular kind of package.
Mike McKee on the latest from the Federal Reserve. A really interesting interview. Catch the rest on Bloomberg.com and on the Bloomberg terminal. Charles Schwab forecasting yields will be lower for longer, saying while the gap between US yields and yields from the rest of the developed world has shrunk, it's still positive. We don't expect 10-year yields to rise higher than 1% through the end of the year. It's possible they don't even rise that high. Colin joins us now. Colin, we just heard from Mike Wilson of Morgan Stanley, who's looking for Treasury yields to drive higher. Why are you on the other side of that trade?
Well, yeah, John, we think it's going to be a relatively slow recovery right now. And listen, at the end of the day, we would love for yields to go higher because hopefully that'd be for good reasons. But what we're seeing is, economic data that, although it's showing signs of improvement, it's going to take a really long time for us to get to what that potential GDP is. And we look at the labor market. We've seen a lot of good numbers over the past few months. Just this morning with the initial jobless claims, that was a positive number. But we're still more than 10 million people unemployed right now, and that's going to take time. And we're going to see some people go from temporary layoffs that will now become permanent. So we think there's a lot of things we need to see happen, especially with the recovery and especially with, on the fiscal side of things. We're not sure what else the Fed will do. We think there's probably plenty they can do, but I think for now they're probably content with their rates near zero and with all their facilities outstanding. I think what we'll need to see now is something on the fiscal side that can get either Americans back to work or money in their pockets.
Colin, people keep coming on this show saying it's going to happen. It's already late. And I caught up with your colleague, Kathy Jones, who said that maybe a policy mistake has already been made. Kathy said, we're going to see more cutbacks in spending. We're going to see more layoffs. Can you speak to that, Colin? The degree to which we've already made a policy mistake down in Washington?
Well, there's a lot of damage has been done. I mean, we talk about layoffs. We see the number of corporate defaults continue to rise right now. The Fed's helping a lot of corporations right now. They're helping, mostly investment-grade corporations. But at the end of the day, the lowest-rated companies aren't being aided too much. And then there's a lot of small companies that are defaulting and just aren't making many headlines. There's a lot of options out there. There was the PPP program, there's the Fed's credit facilities, but stuck in the middle is that Main Street lending program, and that's up and running, but we haven't seen a lot of companies really tap that yet. And I think one issue is the fact that these are loans, not something that can be forgiven like in that PPP program. We see these corporations levering up and issuing debt to keep them afloat right now. But at the end of the day, that needs to be repaid at some point. We need to see profits grow. And until we see a really strong recovery, as you alluded to before, we might continue to see layoffs in the near term.
Colin, 10-year Treasury yields 0.68%. Just last Tuesday, we closed at about 50 basis points. In early June, we topped out at about 90. We're slap bang in the middle. What has moved progressively is inflation expectations. And Colin, it just seems totally at odds with the conversation I have with economists who expect disinflationary forces to persist into 21. Can you just walk me through that, what the economists are looking for and what the bond market is pricing?
Well, when you look at inflation expectations, we look at the TIPS break-even rates, and those have been steadily rising over the past few months. It's almost been a straight linear rise up, and when you look at that on a 10-year inflation expectation basis, I think it's around 170 basis points or so. I think part of that rise has to do with liquidity or maybe lack thereof in the TIPS market. The Treasury market's much more liquid than the TIPS market, so there could have been some dislocations back in March and April that are slowly starting to normalize. But as you said, we're seeing inflation expectations rise. Meanwhile, no one really expects any inflation in the near term. We're in that boat. We don't think inflation is going to be a risk for the next few years. As long as there's plenty of slack in the economy, as long as there's plenty of workers who need to get back to work, we think that should keep inflation low. Down the road, maybe it moves a little bit higher. All this Treasury supply we're seeing right now could have an impact, but we're not too worried about it right now, given just these near-term effects that are likely to keep the recovery relatively slow.
Hey, Colin, great to catch up. My best to you and yours. Colin Martin there of Charles Schwab. Coming up on this program, the analyst action you need to know. That'll be next in our morning calls. And later, Jay Jacobs of Global X Funds joins us at the opening bell as we inch back towards all-time highs on the S&P 500. In the market this morning, good morning, 8 minutes away from the opening bell, shaping up as follows. Equity futures down by not even 0.1% on the S&P 500. Switch up the board in the bond market. Positive economic data, better than expected for jobless claims. Yields higher by a single basis point to 0.68%. And the euro with a lift, euro dollar 118.35. You're watching Bloomberg TV.
Well, position closed on euro at 118.375. We have a profit £200.